Yeah, so I want to talk about we're going to talk about charitable giving and qualified retirement plans. Now, don't when you see that the term qualified retirement plans, that's kind of a mouthful. I really mean IRAs or a 401k. Really any kind of tax deferred account. Um, I want to talk about a couple of really different strategies, I suppose is the right word. But talking about if you have a desire to give to charity and you have a retirement plan, I think these two strategies, you really ought to pay attention and consider these because there's some really nice benefits, really tax benefits that either you or even your family can realize by following these. So the first is a charitable giving during your lifetime with retirement plans. And this is what we call a qualified charitable distribution. And I can say we see this over here at Midland Wealth Management. We have a lot of clients who do this. So let me just talk about what is this? What is this? We call them QCDs, this qualified charitable distribution. It's actually pretty simple. If you have a retirement plan like an IRA, a QCD is a distribution, payment, a check from your retirement account that is paid directly to a charity. Now, of course, the devil's in the details, right? Like, people always want to know, well, why would I do this? How does this benefit me? How does this benefit the charity? Why do people do these QCDs? And here's where you do kind of have to dive a little bit deeper into the tax effects, the tax efficiencies of a QCD, and really, I would say that the main reason people and why you should consider making a distribution to charity from your retirement plan is that the distribution, it's not income to you. Now, you should know, and you probably do know, if you have a retirement plan, when you pull money out of that retirement plan, it's income to you. And when you have income, obviously you have to pay taxes on that income. And with retirement plans, our wonderful friend, the IRS, they say that you have to start taking money from your retirement plan when you turn 72. Don't have a choice. You have to take some money. We call that the required minimum distribution. So when you hit 72, you're always taking a little bit out of your retirement plan, and that's going to be income to you, and that's going to be taxable to you. So you can take some of those distributions, instead of taking them yourself, you can direct them to charity. And the reason this is beneficial, again, it's not taxable income to you. And the reason this is beneficial, particularly in our current tax environment, is because I think it was back in 2017, Trump's Tax Cut and Jobs Act significantly increased what we call the standard deduction. So for example, married couples, the standard deduction is now $24,800. And what that means is, and I pulled some statistics actually last night just to take a look at this. In 2019, only 14% of taxpayers itemized their deductions. The rest, 86% of people, taxpayers, did not itemize their deductions. And what that means is, if they were giving to charity, they didn't get a tax deduction for that gift. And so I think if you are not itemizing your tax deductions and instead taking advantage of the higher standard deduction, you really ought to look at making your charitable bequests from your IRA, because that helps you by reducing your overall income. And of course, when you reduce your income, you pay less taxes. And not that I'm anti-government or anti-paying taxes, but let's not give the government any more than what they need. Now there's some requirements for making a QCD. Not everyone can do this. Probably the biggest one is you have to be over 70 and a half. So younger IRA owners, unfortunately, cannot take advantage of this. Distributions obviously must be payable to charity. I feel like we do a good job at Midland of making sure when our clients want to do this, the check is paid directly to the charity. But sometimes there can be confusion where people will take money out of their IRA and then give it to the charity, and that does not count as a QCD. There's a dollar limit too. You can only do $100,000 in any given tax year. And then lastly, you just need to make sure you're a charitable recipient, is a qualified charity, like the Park District Foundation. Donor advised funds, for example, those are not proper recipients of a QCD. So that's charitable giving with retirement plans during life. Now I really want to talk about charitable giving at the time of your death through your estate plan. And I think there's a really neat way to do this to be tax efficient. And kind of the big idea is, if you want to give to charity through your estate plan, do some plan giving, I would suggest that you consider, instead of naming the charity in your will or your revocable trust, which certainly isn't wrong, but instead of naming them in a will or trust, you instead consider naming the charity as a beneficiary of your retirement plan. And the reason for this, again, is largely driven by taxes. And I thought the best way to explain this is just through an illustration. So I've got this up on the screen. This first scenario here is, I call this the tax inefficient charitable giving at death. So we've got our donor here, John Doe. He's got a couple of assets. He's got $100,000 in cash, and he has $100,000 in his IRA. And John, he's charitably inclined, of course. He wants to split his estate 50-50 between his two beneficiaries. He wants to leave half to his son, Jim, and of course, he wants to leave half to the Park District Foundation. Almost even a lazy approach to this kind of estate plan. And it's not, I won't say it's wrong, but a tax inefficient way to approach this would be, John could say, well, in my will, I'm going to leave the $100,000 of cash, half to Jim and half to the Park District. And then in my IRA, I'll designate half to Jim and half to the Park District Foundation. And at least initially on its face, you can see in the illustration there, each of our beneficiaries is receiving 50% of each asset. And on its face, it can look like this plan worked. The problem is, of course, Jim, he is going to, like most beneficiaries, he's going to take that IRA in one big lump sum because he's got some plans for this money. And so he takes his dad's, our donor, John Doe, he takes the IRA, that half in a one lump sum, and that is income to Jim. He's got to pay taxes on that IRA, and Jim is in our 22% tax bracket for our illustration. So he's going to have to give $11,000 of that IRA to the government. And Jim is no longer terribly pleased with this structure because now he doesn't have a $50,000 IRA. He's left with $39,000 of cash. So there's a different way to structure this, though. Rob, if you could go to the next slide. Thanks. So here's a different way to structure this. And again, this doesn't, I can't go into all the details about kind of the pros and cons, but this is another way of looking at this illustration, and I think it really shows my point. So same scenario, John, he's got $100,000 in cash, $100,000 IRA. Here's the difference, though. Instead of splitting both assets, he leaves his son Jim the $100,000 in cash, and with his IRA, he designates the Park District Foundation as not 50% beneficiary, but 100% beneficiary. Here's why I think this is really neat and why this really works well. The Park District Foundation, they're the same as in scenario one. They receive a $100,000 IRA. They're a charity. They don't pay any income taxes on that money. So the Park District is happy. They receive their money. They don't care where it comes from. Jim, in this scenario, is much happier because the $100,000 of cash he has received, it's not taxable to him. It's not income. The IRS has said inheritances are not taxable income. And so when you compare this scenario to scenario one, Jim is much better off. He's saved $11,000 in taxes. He now has $100,000 in his pocket compared to I guess it would be the $89,000 in scenario one. And so I think you can see pretty easily, and this is somewhat simplified, but I think you can see pretty easily that this is a something you should strongly consider. When you're considering giving to charity at the time of your death, can you accomplish the gift, really fund the bequest through a qualified retirement plan? And I would say there's a couple of just things to watch out for. One is obviously accounts aren't static. They go up, they go down based on if you're withdrawing money, that type of thing. So with this kind of structure, if you're going to do it that way, you have to make sure you keep the estate plan up to date. Make sure you know how much the charity is going to receive from the retirement plan. And then the second thing I would say is you just have to be careful with, Rob, if you could you go back to the previous slide? Yeah, that one. Just have to be careful with, in this, actually the scenario two. So in this scenario, if John Doe, you have to think about this, and this is maybe a little, I don't want to say twisted view of humanity, but you have to think about, if John Doe becomes incapacitated, and say he's named Jim as his power of attorney to take care of his finances, and Jim is looking at his dad's money, and he shouldn't do this, but if Jim is looking at, okay, I got to pay for my dad's, maybe his nursing home, what pot of assets is Jim going to use in this scenario to pay for his dad's nursing home stay? Well, if he dips into the IRA, that could be bad, where now the Park Districts, what they're going to inherit is going to be drastically dwindled, where Jim's cash, if Jim's in charge of the money, his inheritance. Now again, Jim isn't supposed to do that, but those are real life things that people, and maybe it's not even intentional, but that if you're going to do this kind of structure, you just have to think through those and enlist an estate planning attorney like Attorney Fleming to walk you through some of the pros and cons of structuring it this way. But at the end of the day, I think this is something that we all should consider as part of our estate plan.